God does not play dice. Dice is a game of chance. Throw it out there, see what happens. Investing is not that way. Investing is all about risk and reward. We always have to be looking about what kind of risk that I'm taking, what kind of reward that am I going to get. In that strategy that I gave you, risk and reward is pretty easy to measure because we can look at where the values of the bonds are, we can look at the yield, and we can look at the price changes that they've had in different situations and get a feel of how much risk are we taking in order to get a 7 or 8% kind of reward. You should never risk more than 1 or 2% in this environment to get a reward because you just don't get paid to take the risk right now. Times will change. Eventually markets will recover and you will have a chance to take a little bit of risk out there. But this isn't it. So you've got to have a strategy and you've got to have a plan. What do I mean by that? My father used to tell me all the time, Colby, you can do anything you want in your life if you know how you're going to get out of it. You start off with the end in mind, do anything that you want, as long as you got an exit strategy. And that's the biggest mistake that a lot of advisors make in advising clients and that a lot of individual investors make in investing for their own portfolio is they only look at the side of opportunity. What can I get into? How's it going to reward me? But they never think about the exit strategy. They never think about getting out if things get bad. Nobody ever thinks about stop losses. I met with a guy last week. We sat down, we went through his portfolio, and at the end of it, I mentioned to him, okay, I'm going to go through your portfolio, and I'm going to come back to you with price points on each one of these stocks that are either a drop-dead get out, a stop loss, or a price that when it reaches, you should get out. And his response to me was, how can you evaluate my portfolio if you don't know what I paid for those items? My response was, I don't want to know what you paid for those items. I don't care what you paid for those items. I don't want that psychology. Because what you paid for it 6 months ago, a year ago, is irrelevant. I don't care where it was, I care where it's going. I mean, how many of you drive through your rearview mirror? You don't. If you drove only looking in your rearview mirror, you'd crash. And that's what people do with their portfolio when they think about, oh geez, well, I'll wait till it comes back to even. There's not a rule out there. There's no rule that says you have to make your money back in the same investment that you lost it in. There's no rule that says that. In fact, you go to Wall Street and you go work on Wall Street and you sit with guys, you will get beat with a rubber stick if you have that philosophy. That is the last philosophy that they want you to have because the reality is where it was is irrelevant because you probably overpaid for it back then. All that's relevant is where it's going. And so you always have to have an exit strategy in everything that you do. So if you own individual stocks, you got to have stop losses on them. You got to have drop dead, I'm out of there to preserve my capital. Because preservation is number one. If you preserve your capital, you can always come back and fight another day. But if you don't preserve your capital and don't keep that as your number one focus, you don't have any capital to work with. And that's what people have to remember.